All right. Good morning, good afternoon, good evening to everyone out there in YouTube land watching. It is our first Monday market update of 2025. I've got my partner in crime, Nash Paradise, the lone wizard, with me today. I'm Matt Gougé, affectionately known as Matt the Mortgage Guy, and we're going to talk all kinds of stuff. We're going to talk mortgage rates. We're going to talk real estate. We're going to talk the state of housing affordability. We're going to use some numbers. We're going to use some insight from a couple of guys who are actively, involved with hundreds, probably, thousands between our two locales and branches, real estate transactions every year. So you're not hearing it from guys who are just looking at graphs or reading articles. We're in the trenches. So let's get started, Nash.
Let's do it as I sit here pulling up graphs and looking at data in Oh, wait, no. But, like I said, we do it. But, the data is fun, too. So speaking of data, let's recap a little bit about what happened last week. Last week, if you were on, you got to enjoy my beautiful Dorset tones all by myself, which, man, that was tricky trying to get through without you, Matt. I missed you. Please don't ever do that to me again. Like, not being able to see your face and start my week that way, it was rough. Not a good time.
All right. I'll try to go 52 for 52 this week.
All right. I appreciate that. But looking back at last week, the numbers, we didn't see a lot. We didn't expect a lot. Had the market closed early on New Year's Eve, closed all day on New Year's. Everything stayed very, very flat throughout the week. No big misses, no big hits. The crude oil inventory came in a little shorter than expected, but no one cared in the Treasury bond auctions. It was what it was. Honestly, there's nothing very interesting as I look through all the data in the economic calendar for last week. Is there anything you wanted to touch on? It's all pretty standard, straight, as far as I can see.
Well, for the layman watching, and myself being one of them, what Nash is saying is there wasn't interesting thing happening with data. So translation, mortgage rates didn't move a lot. Last couple of weeks, mortgage rates have been pretty flat. And I think that's, what some people are looking for, like, how did that affect mortgage interest rates? So relatively unchanged over the last couple of weeks as far as mortgage rates go. Nothing exciting to report, which sometimes is a nice change from all the volatility we've seen.
I mean, we could use some volatility right now just because we're on the high side of things. But like you said, no news is good news. And we have been mostly unchanged since December 19th, which is, a hot minute. But let's take a look and see what the Fed thinks. I talked a little bit last week about when we expect to see some movement from the Fed. And if we get into the charts here, I'd be curious to get your take now that you're back on when do you believe we're going to see that next quarter point swing. But like you said, first chart here, mortgage rates basically unchanged, 7.1% today from Mortgage News Daily. And that takes us all the way back to December 19th when we hit that for the first time. So nothing new to report there. The other charts, the orange and the black that are starting to catch up, those are just because they're behind right now. The Freddie Mac was last updated on the 2nd, but it's still not caught up to where overnight averages are. And then the MBA index at 6.75 is well off from actuality. It hasn't been updated since the latter part of December, but like I said, they trend okay, but it's not very in line. Any thoughts on this before we get to the Fed stuff?
Not necessarily. Rates being higher like this can be good news and bad news for buyers in the market. With rates being elevated, I know the mortgage applications number was quite depressed last week. So as you would expect, listening to this, when rates are higher, there's less buyers. There's less people that are willing, less people that are able to buy, and so it bodes for less mortgage applications, less demand. Ultimately, if you're a buyer and you have, a life reason or some reason you're out there in the market, now is the time. Last week I saw two people get into contract. One of them on a $499,000 house is getting $27,000 in seller credit, and another one is going to get a combination of price reduction and seller credit. This is the type of stuff that happens when you've got sellers that need to sell and buyers operating in a market where they're not competing against a lot of people, because high rates equals low demand. So that's the silver lining here.
There you go. Love that. Let's get to the Fed. Where are we right now? We're sitting at we just had that quarter point drop, taking us to that 425 to 450 mark. And we had said before for a long time that it was either going to be December or January. I wanted January because when the Fed cut in December, what happened to interest rates? Well, they went up, and that was not fun. So, but it is what it is. As we're sitting here looking at the charts, no move expected for January. Any other anything you're seeing here? It looks like everyone's pretty aligned right now.
Yeah, this was in line that what we talked about, before even December came out. We said, it could come in December, it could come in January. It's going to be one or the other, not both. We got it in December. We don't expect it, to the tune of 90+% of people don't expect it in January.
Now let's take a look at March a little bit further out. I'm still not thinking we're going to see a move, and it looks like the chart agrees with me, but a little mixed, a lot going on between now and March 19th for sure.
Yeah, and I don't know. It's going to be interesting to see. I think that the biggest driver for this, if I were to pick one, right? Because there's economic drivers, there's inflation and jobs and overall economy. The inflation numbers that come out in January or February is going to be the biggest. Like the path to getting this cut is if inflation numbers just kind of outpace what we think to the downside, right? Like inflation is coming down faster than we think. If everything's in line with kind of what's been forecasted so far, and there's no real change in inflation, without any other crazy things happen in the economy, we're probably staying pat, and there's no rate cut, and that holds true. But like the Fed would say, we're data dependent. We got a lot of data between now and a March meeting to look at and justify whatever they end up doing.
Yeah, guess what's not going to happen between now and March 19th?
What's that?
A severe drop in inflation. A significant drop. No, inflation is sticky right now. I mean, you look at the stock market, Taryn, people are still spending money left and right. We have not reached any kind of critical caps as it relates to personal debt. I know we're at the highest point in history, but there's still room. That people are still getting credit extended to them. They still have home equity without moving and scaling up and buying new, more expensive homes and renovating their houses and getting those ready to sell. Without a thriving housing market right now, everyone's just kind of chilling, and you chill long enough, you're going to get bored. You get bored, you spend money. You spend money, you stimulate the economy. We're still seeing a lot of it. I know life is more expensive, but looking at all the spending data for fourth quarter that's been coming out so far, spending's still up there. So yeah, inflation should remain pretty flat through March at least. Let's take a look and see what we're thinking for May and see if that looks any better for a possible drop. Not much.
Wow.
Not much. Yeah, wow. I talked about this a little bit last week because it was the first time we got the May data that had the newest dot plots all put on there. And man, kind of depressing when you look at it. We are slightly giving an edge to a quarter point drop at the May meeting. Man, I don't know. The fact that we're kind of 50-50 and we're hoping for, a lot of people are thinking 3 Fed drops next year instead of the 5 they're originally planning. If we don't see one through May, then the next meeting, June 18th, like we're getting pretty deep into the year before our first drop. That could stall things out a little bit if we don't get that drop in May.
Yeah. Yeah. I still, being the hopeless optimist, know how elevated 24 inflation numbers are, especially I think January, February numbers are quite elevated. And so, maybe we see it, maybe we don't. The thing we haven't mentioned is there's new administration coming in, and there's a whole host of things that we have no idea, right? Like policies that can be enacted and other things that are either, inflationary, non-inflationary, spark the market, depress the market. It could go either way with a new administration coming in. So I don't get too caught up in like, oh my gosh, what do I predict for May of 2025? Because really, like, a lot of this stuff's out of our control.
I do, just because I like to be right. And I like to go back and say, hey, look what I said. If you listen, no, but all joking aside, everything you said is true. We can generally have a pretty good idea what to expect with the new administration, but it is definitely 50-50. Half of the policies sound like they're going to be inflationary. Half of them sound like they're going to possibly depress the markets. There's this mixed bag, and we got to follow the money. And when the money goes one way or another, then we'll start to see where things go. We get some better projections for that going forward. Is that the end of our charts here? I don't think we have anything for June yet. Nope, we are good. Let's get into this week's economic data, because I know we care about it's the first full week of the new year. Happy 2025, my friend. As far as interesting things coming out, we already had the S&P Global PMI came out. It was short a little bit and missed. We thought that would have turned some money into the treasury markets, as it looked like it was going to. Overnight trading was pretty good for us. And then all of a sudden, sells. Sell. There's a good bit of auctions coming up later this week. Thursday has got a couple auctions. Tuesday has got the 10-year note auction. Wednesday we've got 30-year bond auctions. So weird to see selling before the auctions. There's going to be a good bit of supply. We shouldn't have any inventory problems when it comes to those treasuries. What that means to you, me, and a tree is rates are flat, and they should be going down a little bit, but they're not. The big data this week doesn't come out until Friday. Friday, we've got the unemployment rate for month over month in December, and non-farm payrolls. Non-farm payrolls are pretty interesting in that the previous non-farm payrolls figure was 227,000. The projection is 160,000. That is anticipated. As we get closer to the end of the week, when people who know more than we do and have better access to information than we do start to see where it's going to come out, we could see some interesting movement getting into Friday. Friday is not a day that I'd want to be hanging out floating an interest rate, because my prediction, and it's not a strong prediction, I don't feel like very confident about this, but I could see us busting past that 160K number. I could see us being closer to 200,000 on the non-farm payrolls. And a miss like that could be pretty rough for the treasuries, could be rough for the mortgage-backed security market. It could be not very good. I'm honestly surprised that forecast is so far off the previous analysis. We're stuck here where we could be caught with our pants down on Friday. It's just not great conditions for floating interest rates.
Yeah, that volatility you're looking for, since you asked for it, buddy.
Wrong kind of volatility. I want it to be volatile the other direction.
Yeah, I was gonna say when you ask for volatility, I'm like, there's a upside and a downside to volatility. It can go either way. Cool, man. So some data coming out, which we'll review next week as we do each week. Do we got any more numbers or graphs, or do you want to talk about my predictions for the future of home price affordability?
Yeah, let's talk about the fun stuff. All the numbers and graphs in the world aren't that interesting. Like, it's good to explain why, but we have been flat for weeks. We've got a little up, a little down. A lot of like what we just talked about, what we're expecting from the new administration is not moving things in any meaningful ways. So let's talk about some actual meaningful information and projections. Who's winning? How to win? Where is affordability going? What are you thinking?
Yeah, so I read this really interesting article. Matt Graham from Mortgage News Daily wrote it on Friday. And, as somebody who talks to buyers day in and day out, like, I know the struggle, guys. I know that it's hard to buy a house in 2025. It's, not as affordable it's been in other times, especially, those who have got friends or family members or even bought a house yourself in 2021 when you could borrow money at sub 3%. And so everybody's like, the golden question is like, when is this thing going to crack? When is affordability going to be fixed? When am I going to be in a place where I can, buy for a percentage of my income or for a payment that's X in the future? And the truth of the matter is, I don't know if that gets solved, right? There's all kinds of stuff out there that says, home prices would have to come down or rates would have to come down. Inventory would have to go up quite a bit. I don't know if you saw, there's a MBS highway chart that shows like housing starts versus household formations over the last decade.
Mm-hmm.
We're building more people than we're building houses. And so like the supply problem is getting worse, not better. And when there's less supply and more of the peoples in the equation, that has upward pressure on prices. So like everything I look at, being the layman that I am, is like, people, home prices are going to have a real hard time having any significant downside pressure. It's just the truth of the matter. And so, in Matt Graham's article, he shows 2015 or so through current, where like there's really good home price appreciation, like 4 to 7% yearly home price appreciation, which if you're a real estate investor, you own real estate, you own your home, like, yippee, yay, your net worth is growing, your home value is growing, you're paying down your mortgage. That's why people buy real estate. And so, it's a good thing in that way. For new buyers to the market, it continues to outpace the rate of their income increases because they're not getting 7% raises every year. And then you couple that with mortgage rates going up and it gets increasingly harder. It's funny. I was thinking about this over the weekend, Nash. I read this article. I got a buddy who's got a 52-year spreadsheet on affordability. And he looks at like incomes versus home prices versus mortgage rate, average payment, whatever it is. And like the worst year in history was 1981. And in 1981, I was one. My parents bought the house that I grew up in the time when it was like least affordable. And I remember my mom tells this story all the time. I think my dad, as a truck driver, after taxes and whatnot, would bring home like $1,200 or $1,300 a month. And they had a $900 mortgage payment. And so she talks about, she'd clean houses. I think she worked a little bit in the school cafeteria, but, doing all these things to make ends meet because they had a mortgage payment that they quite honestly couldn't afford. But that was 1981. And so I'm curious to hear from you, Nash. And if you're listening and, in the comments, either now or after this thing's posted, what do you think happens? My best guess is that home ownership, like, things change a little bit. Pace Morby and some of these guys who are investors and trying to think about like a true solve for this are doing things like shared housing. Like, does shared housing become more of a thing where there's 4 working class professionals splitting a home, paying $1,600 a room because they don't want to rent an apartment for $3,500 or their own house for $3,500? Does the first-time home buyer age continue to increase? I think it's already at 38 years old. Or is there going to be some miraculous event that makes homes more affordable? What do you say, buddy?
You just asked 31 questions. How am I supposed to get through all of that,
What's the
Gucci?
meaning of life? Answer that one when you're done with the other ones.
Yeah, let me get through that. No, that was really depressing, man. Thank you. I'd like to pretend like any of that's a surprise. Like I haven't been preaching to the choir on that for years and years now. You're right. And you know, it's funny. We're not making that many more people. Birth rates have slowed down a good bit, which causes other potential issues looking forward as we, try to analyze Social Security, replacing the workforce. It's taking longer before there's any kind of inheritance. And by the time anyone inherits anything, it's too late. Like wealth is not moving down quickly enough. So with all that said, yeah, the housing problem is a real problem, and there is a solution. It's just not one that anyone's going to do. I've been talking about this for a while. We need to shift the look of housing. What is housing? That single family home, 2,500 square feet on a quarter acre. Cool. That's not really sustainable long term anymore. We've got to, I've got apartments going up all over 20 minutes from my house. There's apartment complex and then another one. And then you go 45 minutes out where it's just raw land. A lot of Texas is still undeveloped and it's apartment here, luxury condo living here. It's all rentals. Everything's a rental. Everything is for lease. We've got to get some, higher occupancy housing that you can own. That's the only solution. You've got to be able to jump in there and, be 22, 23 years old and buy your 1-bed, 1-bath condo for $165,000 like you used to be able to. And, get normal appreciation rates and roll that into a house with some equity. Problem is, why would you, why skin a sheep when you can shear it for decade after decade? And you look at who's got the money to build these giant complexes. I mean, it's hedge funds, it's foreign money, it's, $1 billion getting thrown around, and they can lease it ad infinitum forever. They can just keep taking your money. It's not their job to solve the housing crisis. So without that, yeah, how do we get more, duplexes, triplexes, quadplexes? Well, the cities and counties don't want them. My city doesn't want them. Average age in my city is going to be close to 50. It's an older, well-established, high net worth area. My kids couldn't buy a house there, and they won't be able to unless I bought a house for them. And I have. I've got a couple rentals that are close enough that they can be, part of the family and still be around. But that's not a reasonable option for most people anyway. You can't just be like, oh, I'm going to buy some houses for my kids so one day they can have no, that doesn't work. It's going to get ugly in the next 20, 30, 40 years as, the amount of wealth gained by, look, I guess they're called Gen Z and Gen Alpha. I mean, Gen Alpha is screwed, but Gen Z is the slowest set of net worth growth compared to the last 4 generations. That sucks. If you don't start early, you're not going to finish well. And if you aren't in the game, like, I'm considered a millennial. I think you're maybe Gen X. We're both very close on that line. But, we got out of college and you may have gotten out of college. I flunked out early, but we got in the job market, in the early to mid 2000s where you could still work and make money and, buy your first house before the 2009 collapse. Seems like everyone after that, it's just been a mixed bag of, yeah, now it's a good time to buy. Then affordability gets a little rough. Then home appreciation. Then COVID happens and everything goes nuts. We've had about 15 years of just difficulty and confusion and not knowing when to jump in. And so they're just, like you said, average age for a first-time home buyer has skyrocketed. And that is mostly based on affordability. But, there are some changing dynamics. People are getting married later. People are getting married at a lower rate. They're not having kids as early or as frequently because they can't afford to. I mean, it's hard to say what's causing which. There's a whole lot of dynamics at play here. But to the original point, it's not going to help affordability. Everything that we just talked about hurts affordability. There is not enough supply for the pent up demand. There are lots of people who want to move, who want to upgrade, get into a different city, zip code, neighborhood, school district, and they're just waiting. And because they have equity already established, they can handle the changeover. Going from a $400K to a $600K home would have been shocking to them 5 years ago, but because they have $300,000 to put down, it's okay. They can weather that. But what they can't do is just jump in and buy that $600K home. They can't take on that $5,500 mortgage payment or wherever that happens to be for them. That's not a reasonable solution. So everyone else trying to jump in, It's a combination of overpaying, and having that debt ratio that is a lot uglier than it used to, just for the hope that one day you can refi into something more reasonable and then start establishing your net worth then. And it's a losing strategy that I just don't see a lot of people taking advantage of.
Yeah, I saw two pieces of positivity in there. And one thing that you mentioned, and I know it, and you know it, thousands of transactions between us. Starting from scratch is the hard part, right? Like 3.5% down FHA, the first house you've ever bought at 600 grand, that's really hard. But if you're able to, and I think that's probably a piece of advice for people out there, like you said, get into the starter place, start small, buy a condo, buy something you can afford. Let this magic of home price appreciation work for you instead of against you, where you continue to be priced out and there's 7% appreciation. Your income goes up by 3.5. And so, that's a good piece of advice. And then something else that, quite honestly got me excited is like things that are worthwhile should be hard. And, I know for sure that the people that I work with and a lot of these conversations I have, like hard doesn't mean no. Hard means like, let me think about it and get creative. Oh, you know what? What if I bought that duplex on FHA and I rented one of the rooms on my side out and I rented the other side of the duplex out? What would that look like? And these are the conversations I have, because people are like, I don't want to hear that it's hard and turn around and just quit. I want to hear like, what are my options? How can I get creative? What can I do? I can't go straight into that $600,000 house with 3.5% down. Cause to your point, Nash, like not a lot of people want to sign up for a $5,000 mortgage, but what if I did something different? What if I bought smaller? What if I house hacked? What if I did something else? Because, if this home price appreciation, and, the current state of the housing market is going to continue to work against me over the next few decades, like the more I wait, the harder it gets. Let me figure out how to do it now.
Yeah. And I think one other key takeaway I'd like to leave anyone listening with, there's a lot of people that I've heard, that are saying, okay, home prices are going to come down. I see these Austin's down 15%. Look at the price points. A $800,000 house now selling for $700K. That was worth $600K 2 years ago. That's not home prices dropping. That is a stabilization and a leveling off. You look at, San Jose, and it's like, oh, well, now I can get this for 1.1 million. It used to be 1.4. That's not home prices dropping. That's a leveling off. That's getting to some normalcy. Now there is some to say like, oh, well, this used to sell for 2 million. Now it's 1.5. Yeah. The home price dropped. You know where that's not happening is the $200,000 starter home. Is the $165,000 condo. Is the $250,000 move up home, which, obviously doesn't exist in your area, but pretend you're in Texas, Matt, and you can imagine what that looks like. It's the entry level. Entry level homes aren't being built. It's too expensive. We talked about this week over week. So don't let, I'm waiting for them to keep dropping. Well, as they keep dropping and interest rates will come down, then I can afford that. Sorry, there's not enough inventory. The pent-up demand for people in their mid-30s trying to buy their first house right now who could easily afford a $300,000 house and aren't taking action, there's a lot of them. You're going to be competing with these people all over the place. And so if there is this little bit of inventory in your area and you're like, well, I really want this, but I can afford that, look harder at that. Figure out, how do I make this work? Because that $235,000 home that you think, man, that shouldn't be worth that. That's kind of ugly and basic. That's your ticket in. You're playing the game. And like you said, it is a long-term strategy. That's the hard, is you may be living somewhere that you don't love. It may be an area that's not the best. It could be a floor plan that's inconvenient. You may have to house hack. I mean, it sucks that these are our recommendations. It's like, yeah, get uncomfortable, but you may have to live in a way that you don't love now so you can love where you live later.
Yep. I love it. All right. I'm going to end it with a Jim Rohn quote. If, don't wish it was easier, wish you were better.
Love it, man.
All right. Have a good week, man. We'll see you next week.
Take care, homie.
Later.